All right. Well, good evening, everybody. Thank you for the next episode of On the Move. I'm Rich Checkan, and I'm one of your hosts. The other host is the distinguished Adrian Day of Adrian Day Asset Management, graduate of the London School of Economics. Did I say that right?
Yep,
Okay.
yep.
All right. I always have to check. And just a good friend, asset manager. He runs the Euro Pacific Gold Fund. We've known Adrian forever. He is our go-to guy when it comes to resource stocks, international stocks, and just the economy in general. And Adrian, welcome. And maybe you can introduce our special guest this evening as well.
I will indeed. Thank you, Rich. But first of all, let me introduce you. You know, it occurred to me, Richard, on these shows, I always say, oh, I knew your uncle for 40, I've known your uncle, sorry, for 45 years, and I've known you for about 30. What a great guy you are. But I never say anything about your background. So I don't know if everybody knows, you're a graduate of West Point. I did look at some of your postings,
Okay.
including Hawaii, so that wasn't so bad, but also Korea.
Can I just tell you a quick thing about that? So I chose infantry, which is a branch that a lot of people get stuck in, right? They don't choose it. I wanted to be a leader, right? So I chose infantry, but I was high enough in the class, which made me really high in the branch. So when we made that next choice by rank, I chose to defend the beaches of Waikiki against enemies foreign and domestic. So but I'll let you go on.
Well, thank you for your service.
I enjoyed it.
Anyway, and you also on the varsity soccer team. So, and did I say you graduated in chemistry?
Yeah. It
Okay,
was
well,
a precursor to med school, which I never went to. So
but I've also known you for probably 30 years or a little bit more.
yeah,
Yeah, about 30 years.
since I started here, yeah.
So this is Rich show. He graciously invited me to be his co-host. So we're co-hosts, and our guest tonight is someone I think you're going to find very, very interesting. He doesn't necessarily shout from the rooftops, so one or two of our guests have done. But anyway, Brent Johnson, he's been in the financial markets 25 years, professionally in the financial markets 25 years. He is now CEO of Santiago Capital. But before that, he was with larger firms, Baker Avenue, which in San Francisco and New York, and was also with Credit Suisse. I'm not sure you still want that on your resume, Brent, but anyway. And after New York and San Francisco, he moved down to Puerto Rico, where he's a neighbor, and we frequently have very, very enjoyable dinners. And the biggest compliment I can give you, Brent, is to say that often when we have an evening out together, and I'm talking to my fiance at the end of the evening, she says, oh, what was the food like? I said, well, I can't remember. So your conversation is so insightful and thoughtful that I don't even focus on the food. And that, for people who know me, really is a compliment. So anyway, Brent, welcome to the show.
Thank you. I'm happy to be here. You're officially one of my favorite people in Puerto Rico. So, the feeling's mutual.
Oh, well, thank you. Thank you. So, the first question, I guess I was asked to ask you this as the first question, and it's not what I wanted to ask as the first question. It's a kind of boring question, but let's do it and get it out of the way. You're known as the inventor, developer of the dollar milkshake theory. So yes. Can you sort of explain to people who don't know what that is, what you mean by the dollar milkshake theory, and how has it been working out in practice?
Yeah, so the dollar milkshake theory is a simplified way to explain how I think markets would react if and when we ever entered a sovereign debt crisis. Now, I started talking about this back in 2018 and really started kind of hitting it hard in 2019. And the reason was because I work with individuals. So I manage money for individuals, and they're really smart and they're really successful, but they're not necessarily, steeped in monetary policy and financial lingo. So I had to come up with a kind of a simple way to explain to them what I thought would happen and why. And even though it was explained as what would happen during a crisis, it really kind of explains the design of the monetary system, really. And so the thesis was, whenever we get into these problems due to all the debt in the world, whether, it was a global financial crisis, whether it was COVID, whether it was, the Euro crisis in the early 2010s, governments and monetary authorities around the world almost always respond by, quote unquote, printing more money, injecting liquidity, doing stimulus, doing bailouts. And I term that as that's mixing the milkshake, right? That's the global authorities getting together and injecting new liquidity into the system. But for a lot of reasons, some of them deserved and many of them undeserved, the US and the US dollar ends up sucking up all that liquidity. Some of it's structural, some of it's just based on the design of the system, and some of it just happens to be because we have the largest financial markets in the world. But when that happens, the United States ends up sucking up a lot of the capital, and that's why you've seen the dollar remain relatively strong versus peer currencies, despite all the bailouts. And it's why the stock market in the United States has continued to outperform the rest of the world. And what I essentially said was, at the time, I said, in the years ahead, interest rates will rise because the debts have just gotten too big. I said the US dollar would rise versus its peer currencies for many of the reasons I just mentioned. I said gold would go higher and that the US stocks would actually go higher as well. And so if I look back over the last 5 years, that's pretty much happened. Now, there, of course, are times when it goes the other way. That's what I term as the terrifying drawdowns along the way. And the reason you get these terrifying drawdowns is because the US is kind of the world's piggy bank. They put their reserves here, they buy the bonds, they buy stocks, they buy real estate. A lot of the excess capital that's been printed gets sucked up into the United States. So naturally, when there's a short-term downturn to concerns of geopolitical concerns or economic concerns or whatever the crisis du jour is, tariffs, the world has to tap their piggy bank. And so US asset prices get sold, and in the short term, they return to their domestic markets. But typically then that reverses. And ultimately, that's how I believe the whole quote unquote end game that many people talk about would happen, is I think the end game happens when the dollar gets really, really strong, not when it gets really, really weak. In other words, if the dollar falls, that's the system perpetuating itself. For the dollar to fall, it means credit's getting extended, liquidity is available. I think that just extends the system. But if we have a crisis where the dollar rises quickly and the powers that be can't get it under arrest quickly enough, then I think that's what brings about the end game. So I hope that explains it.
Yeah. Well,
It does. And I was going to say, just follow up. How do you see that playing out? So we've got a strong dollar. What does that look like to the rest of the world? How does that game manifest?
Well, quite honestly, it's a nightmare. It really is. And because it's a nightmare, this is why there is so much talk and the never-ending narrative of de-dollarization. Mm-hmm. Because the world wants, in many ways, to de-dollarize, but it's just much easier to say than to actually do. I'll try to explain this very simply, because it's actually a very simple problem. But if you don't understand the nature of the monetary system, it can be a little bit difficult to grasp. But I'll explain it this way. We have a debt-based monetary system, which means money is loaned into existence. And that exists in the United States, but it also exists in all the domestic economies around the world. So the money that we all have is loaned into existence in some form or another, and then we will often borrow to then, undertake economic activities. And our goal is always to find an investment or some kind of economic activity that produces a higher return than the cost of capital, right? Yep. So it's kind of a carry trade is what some people would classify that. And that same thing exists in Europe and South Africa and South America and Asia, that same dynamic. So everybody's always trying to get a higher return than their domestic cost of capital. The problem for the rest of the world is that they also use dollars to operate on the global stage. So they also are borrowing in dollars and then trying to overcome the dollar cost of capital. Now, that's all fine as long as currencies kind of stay in a relative band. But the problem is that every other country has to deal with this quote unquote carry trade in two different currencies. The US only has to deal with it in one currency because we only use the dollar both domestically and on the global stage. But Europe uses euros domestically and then dollars internationally. Japan uses yen domestically and then dollars internationally, and so on and so forth. And since we have floating exchange rates where it's a zero-sum game, if the dollar goes up, it means the euro is going down. And if the yen goes up, it means the dollar is going down. It means that every other country is always going to be fighting against one of those carry trades. In other words, if you're in Europe and the euro gets really, really strong, number one, that hurts your exports. And number two, it makes it harder for you to deal with your euro-based debts. But the flip side is if the euro gets really, really weak, that's probably good for your exports. But now that means the dollar went up, and it means your dollar funding is now kind of got a vice on you. And so no matter which way it's going, the rest of the world always has to deal with this cost of capital issue, whereas the United States only has to deal with it in one direction. And that's kind of I don't know if that's a complicated way or a simplified way of explaining it, but that's the big challenge based on the design of the monetary system.
Gotcha. Well, you mentioned several things there I'd like to pick up on in the conversation, but just first of all, you mentioned de-dollarization and you sound a little skeptical on that idea. But let me just put it to you, let me just pose this to you, Brent. If you look at, obviously the dollar is used internationally both as reserves, official reserves, and also as a trade mechanism. And so you can look at those two separately. Of course, there's a reason why we use the dollar for both, but they are sort of separate things. So if you look at, you go back to the beginning of this century, 2000, the year 2000, when people say the beginning of a century to me, I think of 1900, so I have to...
Hard to break that habit.
If you go back to 2000, all of the non-domestic, all of the foreign reserves of all the central banks in the world, almost 80% was in the dollar, right? 80%. 5 years ago, that was at about 70%, and it's now down at about 54%. Maybe not 5, maybe 10 years ago, sorry. So what are we now with 2000? Yeah, 15 years ago, sorry. So 15 years ago, it had come down to about 70. Now it's down at about 54%. And the numbers for the use of dollar in international trade not counting, that's not used in the U.S., that's not the U.S. isn't involved in, trade between Brazil and China or Saudi Arabia and Germany or whatever. That percentage has also come down, not quite so dramatically. But I guess what I'm saying is the direction of travel in both looks fairly clear. And obviously the confiscation of Russian reserves or assets at the start of the Ukraine war just gave us a special impetus to that drive to move away from the dollar. So I guess what I'm saying is we have seen a move away from the dollar. Yes, the dollar is still dominant. There's no question about that. But is it, I'm often reminded of that overused phrase of Hemingway, about how you go bankrupt. Well, how do you move away from the dollar? Slowly at first and then suddenly. When we get to more than 50%, I would imagine we could start to see a rapid decline. I don't know. How would you answer that?
So there's two things here. And the ironic thing is it sounds very counterintuitive. But I'll explain why I believe this is. I mentioned earlier, as long as things stay within a band, it doesn't really matter which way the currencies go. And when I often talk about de-dollarization, I kind of mean wholesale de-dollarization to where the dollar is no longer the dominant currency and some other currency has kind of taken its place in the United States. no longer has the kind of exorbitant privilege. And so while you can have some de-dollarization, you cannot have wholesale, systemic, full-scale de-dollarization, and without having a lot of pain. And the reason, again, goes back to the design of the system. All of the money, all of the dollars that exist in the world have been loaned into existence. And so if you're going to de-dollarize, that means you're also going to deleverage. You can't get away from all the dollars without paying off all the dollar debts. And I think most financial participants know that the United States owes like 36 trillion national debt and over 100 trillion if you start adding up all the, you know, unfunded liabilities and government or corporate debt, et cetera, et cetera. But what many people don't know is that the rest of the world owes just as much, probably more, in dollars. So there's at least 20 trillion of on-balance sheet debt that the rest of the world owes in dollars. There's the IMF, or I'm sorry, the Bank of International Settlements estimates there's about 70 trillion off-balance sheet that the rest of the world owes in dollars. And then if you start talking about derivatives and unfunded liabilities overseas that are based in dollars, it's over 100 trillion. And all of these are estimates because it's really, really hard to get your hand on the actual number. But the real kicker is that they don't owe those dollars to the United States. They owe those dollars to each other. So they can't move on fully from the dollar without paying off those debts. And if they were to decide that they were going to default on that debt, they're not defaulting on the United States, they're defaulting on each other. So there would be a huge loss of assets if the rest of the world gets rid of their US dollar debt, they're getting rid of an equivalent amount of US dollar assets. So that would put many countries, many entities, many corporations in financial straits if all of a sudden their assets just disappeared overnight. And I would argue that when you mentioned that, you know, the amount of dollars used in trade has gone from like 80 to 70, and now it's like in the low to mid 50s.
That's reserves. I'm sorry. Not
right.
Yeah.
Right. Well, I would say that ironically is part of the reason why I think the dollar has remained strong on a relative basis to other currencies. And what I mean by that is you have to remember all this debt that I just talked about, all that debt has to be serviced and it has to be paid off. And as long as that debt exists, there's demand for dollars for entities outside the United States that have to service and pay off those dollar debts that they owe. But now if they try to de-dollarize, and so fewer dollars start circulating, naturally, if you're going to use the dollar less in trade, there's going to be fewer dollars circulating. But all of that debt still exists. So now you still have the same amount of demand, at least from a debt perspective, but now you have less circulation. So if demand stays constant, but supply falls, price rises. Now, of course, then the Fed comes in every now and then and adds more supply, and they do bailouts and stimulus. And so the dollar gets higher and then it comes down, the dollar goes higher and then it gets down. But I think that's kind of my point, is that the world can absolutely de-dollarize, but they cannot de-dollarize in a peaceful and non-volatile manner. To go from the system we currently have to a new system where the dollar is no longer the quote unquote reserve currency would either have to be globally coordinated on an extremely sophisticated scale, or it would have to be done by a great volatility. And my bet would be on the latter rather than the former.
Well, we must continue this over a glass of wine and some food. I don't know what food sometimes, but let me just, I mean, that surely was not the case in 1945 when the dollar took over from the pound. Yes, there was an awful lot of pain, but the pain was to Britain. I don't think Japan or Germany or the United States or Canada suffered because the pound was no longer, used in international reserves and was no longer a huge trading currency. I mean, it was huge pain for Britain.
Yeah. Well, the reason is that was a little bit different system than what we have now. At that time, you were going from one sovereign that was on a gold standard, being the global reserve currency, to another sovereign that was on the gold standard, being the reserve currency. So that's part of it.
Okay.
The second part of it is that this quote unquote euro dollar market that I just talked about, this market of dollars outside the United States that has nothing to do with the United States other than it's denominated in dollars, didn't exist to the same extent that it existed, that happened in, in 1945. Now, I'm sure somewhere outside of England, somebody owed somebody else in pounds, but not to the extent and not as systemic as it is now. And part of the reason that it has part of the reason that the euro dollar market, and just for people who are listening, I'm not talking about euros. Dollars that exist outside the United States are called euro dollars. The reason they're called euro dollars is they started in Europe post World War II. Banks in London and then other parts of Europe, started lending out dollars rather than the local currencies. And it grew and it grew and it grew. Part of the reason they did it was it wasn't regulated the same way lending in pounds was. But anyway, this market grew and grew and grew. And then what really set it off was when the United States delinked from gold in 1972, when Nixon took us off the gold standard. There was about 6 to 12 months where currencies literally were just free floating and everybody was trying to figure out what to do. And about a year later, the US convinced Saudi Arabia to price all of their oil sales in US dollars. And in exchange, the United States would provide protection and help them develop, Saudi Arabia into a modern day kingdom. And they have, and that's exactly what's happened. But when oil became priced in dollars as a standard form of pricing, that now meant that the rest of the world who had to power their economies with energy and with oil had to either have dollars or had to hedge their exposure to dollars in order to buy that oil. And when that happened, that really turbocharged this euro dollar market.
Right.
And, from 1972 to 2022 or 2024, 2025, over that 50-year period, the euro dollar market has just gone exponential. I mean, it's enormous. And it's probably the biggest network in history. I can't think of anything else that would be bigger than that other than potentially, a language. And in many ways, the dollar is the language of international commerce. And so I would argue that oil for dollars deal was probably the biggest event. It's hard to say it's the biggest event of the 20th century, but I'd put it in the top 5 as far as ramifications for the future.
Yeah. And it's funny when you were talking about, in exchange, the US would provide security and investment. Doesn't that remind you a little bit of what's going on now?
Well, yeah, I picked up on that too, and I was going to get there. I think we're going to go there next, but before we do, Mark asked a question here that I think is relatable to what you just touched on. He says the dollar fell significantly in the 70s. Was the system so different back then because of Bretton Woods, or was the dollar debt between countries large like it is today?
So ask the question again.
So he says the dollar fell significantly in the 70s. Was the system so different back then because of Bretton Woods, or was the dollar debt between countries large like it is today?
So the dollar debt between countries wasn't nearly the size that it is today. But that's when it kind of started its rise. And that's also part of the reason why I want to make sure it starts to get confusing because you have to remember whose perspective you're looking at it from, right? Are you looking at it from a foreign perspective, or are you looking at it from a U.S. perspective? But, you know, in the 70s, even though we were now sort of on an oil standard, we had delinked from gold, which allowed the money supply to expand greatly, right? And then that led to, you know, the high inflation that we had in the 70s. And at that time, there wasn't as much demand for dollars outside the United States. It was rising because of the oil deal, but there wasn't as much demand to service the debts that there is today.
And
So
the debts were growing because of guns and butter, basically.
and exactly. And so, you know, and then by the time we got to the mid 80s and Volcker had jacked interest rates up, you know, that's when, you know, I think if you go back and you look at the early 80s, it wasn't just the United States that was in a recession and that was dealing with the strong dollar. It was, you know, the rest of the world was as well.
Gotcha.
Right.
So, Adrian, I know where you want to go next. I think we should go there. You know, apparently Mar-a-Lago is not just a place in Florida. And it may be the beginning of the new world order. So this whole concept of basically, you know, linking dollars to protection. And, you know, the concept that I know you made the case that, you know, the rest of the world with the dollar's reserve currency basically has to, you know, it's got two different ledgers it's got to pay attention to. But President Trump is making the argument that, you know, basically the world has been getting over on the US. We're providing that protection. It comes at a cost, and that cost is the strong dollar as the world reserve currency. And it's time for the rest of the world to pay up. So this is the idea of the Mar-a-Lago Accord. And I'd just like to first get your take on it. I mean, I've heard of some of your comments in the past. Do you believe this is, you know, something they just stumbled on, or do you think this is a premeditated walk down a specific set of guidelines and tasks to get to a distinct endpoint? I think I know your answer, but I would like you to share it with everybody.
So I think it's such an interesting question. And so what's really interesting about it to me is after college, I went to get my MBA, and I did it at a school called Thunderbird, which was an international business school.
Yep.
And at the time, it was the #1 ranked international business school in the world. The reason I say that is because most people who haven't heard of Thunderbird don't have any idea what it is, but, you know, it is a fantastic school.
I know.
And one of the things that they taught us was basically the quote unquote rules-based order that was established post World War II. And this was essentially you could call it unofficial, but kind of an unofficial / quasi-unofficial way the world agreed to interact with each other on an official basis and on a national basis. So what I mean by that is, you know, that post World War II, the United States was the undisputed leader. And then the allies who were, you know, allied with the United States in World War II were kind of the next level down. And then all the countries that were either opposed to the United States or small and developing came below those. And so they set up the United Nations, and they set up the World Bank, and they set up the IMF, and they came up with a set of protocols for how different countries interact with each other as far as tariffs and trade. And so, but there was a method to how it was done. And the idea, there was two ideas, and it all depends on whose side you believe. But one idea was that it's a way to cooperate and to try to think of the good of the world overall in order to never have another World War II. The other version is that it's a system of control that favors the guy in power and set up to you know, rig the system so that he always gets the most votes. And I think there's probably a little bit of truth to both sides, but that's essentially how it worked. And what I think's interesting about this now is this is all coming home now. Because I know how it was set up to work, it's really interesting for me to sit here and watch it get torn down. Because that's what's happening. Like, Trump is literally tearing down this rules-based order. It doesn't mean that he is relinquishing hegemony or that he's relinquishing the U.S. ability to influence the rest of the world. He is just no longer doing it, quote unquote, for the greater good. And he is doing it unapologetically in the interest of the United States. And, we're going to do what we need to do for the good of the United States. And if that's good for the rest of the world, then I'm really happy about that. But if it's not good for the rest of the world, well, that's just too bad. That's a very different way of doing things. Now, whether this needed to happen or not, and whether or not the rest of the world was getting one over on the United States as a result of this rules-based order really depends, again, on whose point of view you're looking at. And not just from a country basis, but from within a country. So I would argue that let's just call them the 1%ers, for lack of a better word, the elite, the status quo, the 1%. I would say that the rules-based order worked absolutely incredibly well, because they are the ones that own all the assets, and asset prices went absolutely through the roof. The pace of growth of the 1% versus the average everyday person, the inequality just exploded. And part of the reason is because the US, all they have to do is print these little green pieces of paper, export them to the rest of the world, and in exchange, we get things like oil and cars and houses and clothes and, iPads for printing something out of nothing, right? So it's hard to say the system didn't work well, because I would say it worked extremely well, but it worked well for a very small percent of the population. Who it didn't work well for is the average citizen, right? Or the not 1%, the Joe Main Street, who saw their jobs get shipped overseas and saw their wages stagnant for 30 years and saw their cost of living rise year after year, even though their paycheck didn't. And that's because the world became more globalized rather than nationalized, right? So Trump, though, he doesn't like that system, and he thinks he's not a globalist, right? So there's a group of Americans who are globalists and Europeans who are globalists, and and they all went to the same schools, and they're the ones that crafted this new world order, the rules-based order. But, I would argue that the pendulum swung so far to one side, it was finally due to swing back the other way. And it's not so much Trump doing the changing as he's just the guy at the moment when the change needs to happen. And so he is trying to change the system to where it's no longer a globalist system. It's more of a nationalist system. It's more of a mercantilist system. And part of the reason I think this is all happening is because the whole world is in trouble. Forget the geopolitical disputes. The whole world is in trouble economically. So everybody knows the struggles that the United States is now in due to the fiscal deficits and the budget deficits and all this stuff, right? But the rest of the world is in the same shape. If there was another country out there who hadn't gotten themselves into the same predicament that the United States has, they'd probably be sitting pretty right now.
They'd rise to the top. Yeah.
But there really isn't, right? I would say the one that has probably managed their finances the best is Russia, but it's a very, very small economy, right? It's a very powerful country, but it's a very small economy. So everybody's kind of in the same situation. And all of the politicians for 30 years kind of ran the same policies, right? And so now they all have to deal with internal strife. And what do you do when you get internal strife? You don't blame yourself. You don't take responsibility. You blame that evil foreigner over there who has been manipulating us and taking advantage of us and da-da-da-da, right? And so I think largely all these countries are doing this, right? And so it's kind of this is all coming about at the time when all these countries are struggling and dealing with these massive debts that they have. A lot of the social policies that they put in place for 30 years are now being pushed back against. And when things are going well economically and everybody's making money, you can kind of gloss over some of the problems. But the minute things don't go so well economically, then every little problem feels like a bigger problem. And I think that's largely what's happening. And I think it's happening on a global basis. And so what I think we're going into, I think we are going back into a type of system that was kind of the norm for hundreds of years, where politics and global geopolitics was more based on power, just pure power, than on, economic efficiency. I think for at least as long as I've been in this business, 25 years, God, it makes me feel old, but I've had the luxury of being able to analyze things just based on the numbers. Unless I was investing in an emerging market, I didn't really have to worry about geopolitical conflicts or, government policies or currency rates, because for the most part, in Western developed markets, everything was peaceful. But I think those days are kind of going away, and we're going to have to start thinking about things like geopolitics. In other words, decisions, I think, are going to be made based on national security. It doesn't matter whether you can buy the cheapest widget from China. We want to buy it from a partner or an ally that we, quote unquote, trust more, right? And so if that costs twice as much, so be it, because our national security depends on it. And so I think the days of just looking at the numbers are largely gone. And I think people who probably haven't been investing in emerging markets for the last 30 years probably have a leg up right now, because they're probably used to dealing with these kind of issues more than people who have just invested in developed markets. So that was a kind of a long, rambling answer. I hope I didn't go too far off track. But
No, there was a lot of interesting stuff there. But
Yeah.
one of the things, I'm a little bit concerned about, and you didn't actually say whether you think Trump is playing 4D chess, which makes everybody smile. But
yeah.
Sorry, go on.
No, I would just say, I don't think Trump's playing 4D chess at all. I think he's telling everybody exactly what he's going to do, and they just can't handle that he's going to do it.
They don't believe it.
They don't believe it.
They don't believe it. No.
Do you think everybody is familiar that's listening with what the Mar-a-Lago Accord is? What are the
Probably
tenets?
not.
Maybe
not.
we should cover that real quick. Basically, it's about changing from, being a beneficial, superpower to basically ruling with, more of an iron fist and using a stick instead of a carrot. Am I correct?
That's right. And so, the idea is that, because of the role of the dollar and because of the euro dollar market grew so big, and because whenever we get a downturn, then people sell US assets, that the Fed would then rush in and provide the liquidity to the whole world. They do it to the United States through, PPP loans and quantitative easing and bailouts of banks. And they would do it internationally through swap lines, right? They would give a loan to the European Central Bank, and then the European Central Bank would give a loan to the Bank of France, and then the Bank of France would give the loan to Airbus, just as an example. But that's how the U.S. would run, annual budget deficits and trade deficits, and that's a way to get dollars to the rest of the world. So the Mar-a-Lago Accord is basically trying to reset that, because Trump will say, we have provided the blood, right? The liquidity that the entire world runs on. And we have provided the, safety of the seas, and we've patrolled the shipping lanes. And as a result of that, prices have been a lot lower for the rest of the world, but it hasn't benefited our Joe Main Street. And if we are going to continue to do this, then you are going to pay us to do this, or you can do it on your own, and we won't provide these services to you anymore. And you can go get your dollars somewhere else, and you can get your sea lanes protected somewhere else, and you can, that's kind of the idea of the Mar-a-Lago Accord. It's basically a tearing down of the rules-based order and just saying, this is the U.S. order. And it's, I don't know if people have ever heard of this book. I've talked about it quite a bit. There's a book called The Storm Before the Storm. And it's about Rome in the years 120 to like 60 BC. And it's the time before Julius Caesar. And it's a 60-year period, which it's pretty incredible, the similarities to what's going on in the world today, especially as it relates to the United States. And it's essentially, though, it's the fall of the Roman Republic, but it's not a fall of the Roman Empire. It's the rise of the Roman Empire. It's the fall of the Republic, and it's the rise of the empire. And I'm not going to sit here and say the United States is going to run the world for the next 400 years the way the Roman Empire did. But that's probably the closest thing that I can equate it to historically, because we've had this quote unquote rules-based order, this, system that was based on the goodness of all and not equality, but, benevolent hegemon. And I feel like we're probably moving into a system where the benevolency is gone, but the power still exists. And I think some people would argue that the power is perhaps not there anymore. And I understand that, but on a relative basis, I still think the United States is the most powerful country in the world. And I think the world is, and this kind of goes back to Adrian's point, I think the world just can't believe that this is happening. But I think we're going back to this period of time where power, as opposed to morality, rules the day. And I'm going to say one thing, and then I'll be quiet and listen to you guys. But when I talk about this stuff, and this is not what I think should happen. I don't think this is necessarily the right thing. I just think this is the way it is. And I try as best as I can. I'm not always successful. I try to remove my own sense of ethics and morals and from what's going to happen. And when I analyze what's going to happen, I try to remove my own opinion on whether it's right or wrong and just figure out what's actually going to happen. It doesn't mean you need to become a total mercenary who has no feelings, but I think when you're putting your hard-earned capital on the line, if you're going to make a bet with the money you worked so hard for, I think you got to be realistic about it rather than just hopeful about it.
Well, I was actually going to ask you about that because I think you're one of the people in the business who does that, separates what you want, or well, first of all, is what you should happen, what you want to happen, from what you actually think is going to happen. And I know you've had some criticism before from people, if you say the dollar's going to be strong and everybody sort of...
They hate you like you made that happen.
Yeah.
Yeah.
I wanted to, and I'm sorry to talk so much tonight, Rich, but...
No, that's okay.
I'll be quiet after this, but you talked, there's so much you said there. But you've said many times, Brent, you've said it depends what side you're looking at it from. And of course, everything that happens, there's two sides to it. If the dollar goes up, it benefits some people, it doesn't benefit, it hurts others. If interest rates go up, obviously, if I'm a lender, and I've got variable rates, that helps me, and so on and so forth. But I think one of the problems that I see with this whole what we'll call the Mar-a-Lago plan is, to me, there are some contradictory, there are some aims that contradict each other. You had, or could be very damaging. So you had an excellent article today with a very provocative title: "What happens if Trump wins the trade war?" I thought that was... But there's a couple of things you mentioned, and then I'll be quiet. I mean, well, three things I'm going to mention. One is you mentioned all the cheap, whatever you said, widgets that come to the US. But then, if you look at Walmart and you see jeans that cost $17 a pair, believe it or not, I know it's true. Jeans that cost $17 a pair, that's because of China and outsourcing to Vietnam and Malaysia and Bangladesh. And so if we're going to make those things more expensive, who is it hurting? It's hurting the poor people in the US. It's not hurting the 1%. The second thing I'd mention is, well, in your piece today, which was very good, you mentioned that you thought the US had a lot more flexibility in this trade war than does China. I'll let you explain that if you want to, because you'll do a better job than I would. But one of the things you mentioned was that China is very dependent. You know, they have a huge labor force working, and you posited how many of those those workers are actually producing things for the U.S. market. And if we and you talked about the number of people that are being laid off in China. Well, don't we in the US, isn't it in our interest to have a prosperous China? Because I fear, I mean, I really do tremble with fear at what could happen if half of the Chinese labor force is laid off. These are predominantly a male population because of that horrible two-child policy they had. So predominantly a young male population. So you who've come from the country into the city, you know where I'm going with this. Can you imagine what happens if you have a huge unemployed male labor force? You either have riots or you enlist them in the military. So I would say that's not in the US's best interest. And then lastly, I'll just leave with this, the dollar. You know, the US is doing a lot, President Trump is doing a lot of things to drive the dollar down. And as you say, a lot of foreign investors, they haven't got the message yet. I mean, Trump is telling them as plainly as he can, but they haven't got the message. They're still pouring money into US stocks. But so on the one hand, we're trying to push the dollar down. Taiwanese dollar went up, and the Korean won went up. They're negotiating now on raising about the exchange rate value of the yuan. But how does that help the US Treasury market, particularly the long-term Treasury market, which is dependent upon, other than pension funds and insurance companies, is dependent upon foreign buyers? How does that help if the dollar's going down?
Yeah. So let me try to take these one by one, and they're really good questions, and it gets really interesting. So first thing I'll say is that part of the reason we wrote that article today, because it feels like to us, whenever we read an article or a report or we listen to an interview on this topic, it talks on and on about how in the hell is the United States going to deal with this? And many of these problems that you just rightly brought up. And I don't disagree with those at all. But what I would say is very rarely do I read an article or listen to an interview where people talk about the challenges on the other side. Because again, there's always two sides, right? And so we think it's worthwhile to think about the other side. The other thing I'd say is this, whether we like it or not, this is a fight. It is. I mean, there's just really no other way to say it. And I don't know anybody that goes into a fight, even professional fighters don't go into a fight without expecting to get hit. And they probably even bleed. Maybe they get a black eye. Maybe they break their arm. But it's not the guy who never gets hit that wins the war. It's the guy that's still standing after all the blows have been thrown, right? So I'm under no illusions that the United States can, quote unquote, easily win whatever conflict we have. I don't think that's the case at all. I just think that the United States has the ability to throw knockout blows that the rest of the world doesn't. And I think the rest of the world is in much more dire straits than many American analysts typically give providence to. But I think the point that you just touched on is probably the most important thing that Trump has to deal with. And that is these conflicts in what he's trying to achieve. And there's two main ones. Number one, he wants tariffs. He wants the rest of the world to pay for the services the United States provides, but he also wants a lower dollar. Those two things are very much contradictory. And how he plans to do that, I'm not quite sure.
That where the 100-year bonds come in.
Well, I think part of it does, right? And this is, you know, to your point, Adrian, I do think this will lead to challenges in refinancing all this debt. And I think that's where the 100-year bonds come in. It's where, you know, if you want to be part of the system, if you want access to a swap line, you better show up at the Treasury auction, regardless of how much you hate doing it. It's kind of like back in the old days when the king called his bannermen, he's going to war and he calls his bannermen. Are you with me or not? You know, this is your time to step up or not. And if you're not, then you and I are going to war before I go to the big war. Right. So I think that's going on right now. But I think the biggest challenge, more so than managing the dollar, I think the biggest challenge Trump has is the issue that Adrian touched on. So I think more than anything in the world, Trump wants two things. He wants his face on the front page of the New York Times talking about this golden age of
Usually the
America.
New York Post. He doesn't read the Times. He reads the Post.
Yeah, but I think he secretly wants
You'd like
the
to
New
see
York
it in the
Times.
Times, yeah.
Okay.
Yeah. I think deep down, that's his insecurity. I think that's what he wants.
Okay.
And then, of course, he wants his face on Mount Rushmore as the greatest president ever, right? Probably a big mountain next to it that's all his own. And so the problem is China, right? You can't get your face on Mount Rushmore if while you are the president, China surpasses America. That doesn't lend itself to greatness, right? At least from his point of view. And that's, you got to think of him. You have to think of how he thinks, right? Not how I think or you think. You have to kind of try to think like Trump. So that's number one. But the other thing is he has to figure out how to keep China in a box without China collapsing. And that is harder to do than I think people appreciate. Because China collapsing is a nightmare for everybody. I mean, so many bad things come out of that it's hard to see him overseeing a golden age of prosperity if China collapses. And if China collapses, that's not Trump getting a great deal. Trump wants to be seen as this great deal maker. And when he says we want a prosperous China, we want a prosperous Middle East, we want a prosperous Europe, we want a prosperous Russia, I think he means it. I actually do think he means it. He just wants it on his own terms, right? But I think it's really going to be really, really hard to get this golden age of economic prosperity if China goes down the tubes. If China were to have to devalue their currency, which I think it's a legit concern, and I did a whole podcast on it a couple of weeks ago why I think that's a concern. But that would cause probably a global financial crisis if that happened, or it has the potential to anyway. And so it's hard to see how that's good for America, right? And to Adrian's point is, if all these kids get laid off, where do they go? Then they go to the military. And in the same way I talked earlier about, politicians around the world blaming the evil foreigner. If China goes into a tailspin, do you think Xi's going to say, "Oh yeah, it was my fault"? He's going to say, "No, that was that evil America. They are trying to, immorally keep us down, and this is our time to fight." And that's not good for anybody either. And in some ways, not exactly the same, but part of the reason that China has troubles right now is they don't produce oil. They have to import their energy needs, right? And they have to use dollars, or at least even if they use yuan, it's still priced in dollars. So they still have this, and even if they get some from Russia, it's still priced in dollars. So they have this big problem in that they're a growing power, but they have these energy needs. And I don't know if you guys remember, what led Japan to kind of strike out against the rest of the world 100 years ago is they needed energy. They needed oil, right? They didn't have a good source of it. And, I hate to draw that parallel. I'm just saying it exists. And so, again, I think that is the biggest challenge that Trump has, is trying to figure out how to balance this all in. Like, he is literally playing with fire. I mean, I've characterized this as a Game of Thrones, kind of jokingly, but I actually think that's correct. I can't really think of a better analogy because I think that's what's happening. I think all these different countries are kind of jockeying for position. and there's twists and there's turns, and one minute you think somebody's an ally and the next minute they're stabbing you in the back. And at the end of the day, everybody's out for themselves. And, it's, the pendulum is swinging the opposite way it was, 10 or 20 years ago.
Yeah. That's good.
And I don't mean to sound so horribly bearish because I'm actually a fairly positive guy. I don't walk around with a cloud above my head. But there's just a lot of challenges going on right now.
Sure.
If we could, we got a bunch of questions stacking up, and I do want to touch on your thoughts on gold as well before we get done here tonight. But to kind of close this out, I kind of look at this whole thing as just kind of a big gamble, and I hope it works out for us and for the rest of the world, honestly. But the big gamble is, if the U.S. takes on this role as we are, eventually it may on, are we, this whole idea of weaponizing the dollar and weaponizing markets and, weaponizing economies. Are we pushing the world away from us? And do you think they would go to the other side? Or do you think that, the U.S. just has so much to offer in terms of, just consumer markets? For one, that the world is going to stay on this side of the aisle, if you will.
I think there's two parts to this. Number one, I think the U.S. still does have an incredible amount to offer. And if anybody has ever had a job in sales, that your best customer is your current customer. And you are better off keeping your current customer happy than trying to go get a new one. Even if it means making concessions to that customer, it is probably worth it, because replacing your biggest client is really, really hard to do. And in many ways, the United States is either the first or the second biggest client to everybody in the world. They have produced and they've taken out loans to manufacture production that then gets sent to the United States. So to lose that big client has incredible ramifications for the rest of the world. And this is kind of one of the points I was making in the paper that Adrian mentioned earlier. The other thing I would say is that I think because we have lived, or at least I have, I'm very fortunate, have lived in an era of relative peace, right? There's been some skirmishes over there. We haven't had it here at home. That we've kind of gotten into kind of a false sense of reality as to the way much of the world was historically. Right. And we have grown up believing that all you have to do to defeat a bully is walk up on the playground and punch him in the nose. But I've actually been on a playground when this happened before. And
how did it work out?
When the little guy walked up to punch the big guy in the nose, the big guy knocked his teeth out. Yeah. That's usually what happens. Now, that's not fun to talk about, and it's not, it doesn't make for a great movie, but that's kind of reality. And not only does the big guy usually win, but then all the other kids, and I've seen this happen too, run up next to the big guy and be friends with him because they don't want to get hit next.
Like
now, that's not nice, but that's reality. And so I think there's some of that going on as well. Now, undoubtedly, there will be a few brave souls who say, you know what, screw that guy. I don't want anything to do with him. I'm going to go find somebody else to play with. And, I think that will happen. And I think that's why this is probably not going to get solved anytime really soon.
Gotcha. What do you say, Adrian? You want to take a couple questions here?
Yeah, but we also want to make sure that Brent gets an opportunity to tell us what he does.
Yeah, why don't we do that right now?
Okay, and then we'll talk about gold afterwards.
Okay.
So Brent, this is your time. This is the advertising intermission.
Okay. So, I have a registered investment advisor. I'm registered with both the SEC and the National Futures Association. I manage money for kind of a select group of high net worth families and individuals. And I do that through a combination of customized, separately managed accounts and private funds. And, I've been doing that for about 25 years. And I worked for big firms in the past. And it was great because I learned a lot about how the system works. and I learned a lot about how I didn't want to act in my own practice. And so ultimately, launched my own company to do that. In addition to that's the main part of my business, but we also, just in the last year, we started writing research. If anybody's interested in kind of what we've been talking about today, I've been writing a lot about that. There's both a regular version and a premium version available for that. If you're interested in that, I'd point you to santiagocapital.substack.com. You can find out a lot more information there. And then once a week, usually on Sundays, I do an episode. I have a show on YouTube. I call it Milkshakes, Markets, and Madness, where I just kind of discuss either what's going on in the world or some specific topic that I think is, relatively timely and important. So, and then I'm very active on Twitter. If people don't know, I like to mix it up on Twitter. And I always say I take my job very seriously, but I don't take myself very seriously. So I find this social media, a lot of people get stressed out about it. To me, it's like a stress reliever. It's fun to go on there and kind of mix it up and debate with people. And, if it's not necessary, it's a jungle. So it's not for the lighthearted, but it is kind of fun.
Well, just before we get off what you do, I do want to mention one thing you do, and is part of your part of a research, which I think is a subscription based, but you have this thing that comes out every so often, maybe every couple of weeks or something, called TLC, which is not Tender Loving Care, but is Think, Laugh, Cry. It's the most incredible thing I read. It's the only thing that when it comes into my box in the middle of a trading day, I say, forget my clients. No, I don't say that. I'm going to read this. So can you tell us about that and
Sure. Yeah. So well, first of all, I appreciate you saying that, because I actually really like writing it. And it's a way to kind of think about some deeper things than how do I make some rich guy richer, right? I mean, that's my day job, is keeping rich people rich, which it's important, but it's not exactly, changing the world, so to speak. So I do like to think about things other than just my job. And TLC, so Think, Laugh, Cry, it's based on, there was a very famous basketball coach back in the 80s who took his team and won a national championship. His name was Jim Valvano, and he was an underdog. He never even should have been in the tournament. And somehow he gets his team there and they go on and they win it all. So he became this very famous coach, and he was a very inspirational guy. And about 10 years later, he contracted cancer. And right before he unfortunately passed away, but right before he passed away, he was invited to give a speech on ESPN.
Yep.
And if you haven't seen the speech, it's the most incredible speech you'll ever listen to. And the message was, don't give up, don't ever give up. That's what it's known for. So that's kind of a motto that I've, embodied. But my favorite part of the speech was, he talked about, he does 3 things every day. And he says, if you do these 3 things every day, you're going to have a heck of a day. You do that every day, you're going to have a heck of a life. And he said, you should think, spend some time in thought. He said, you should laugh, because life should be full of joy. And then he said, you should cry. If you find something that makes you cry, then you've had your emotions really moved. And he said, if you do those 3 things every day, it's a heck of a day. So that's the provenance of that. And so I started, as part of I wanted to write something that wasn't so hardcore finance. And so it's a pretty short publication. It's typically 1 or 2 pages on each of those topics. And so I try to write something that made me think. I will have read something or listened to something that really made me stop and think. So I'll write a couple pages on that. I'll hear a joke, or I'll see something on TV that made me laugh. So I'll post that. And then I'll find something that kind of makes you think a little bit and cry and, move your emotions a little bit. So I appreciate that you like it, because I love writing it.
Well,
Yeah, I will tell you that is beyond a powerful speech. I've seen it, I can't tell you how many times. And the other part of it, besides that, where he says that's one heck of a day, is where the guy's giving him the time cue, saying it's time to leave. And he's like, I got cancer eating my entire body up, and this guy is trying to tell me I got 5 minutes. The hell with you, or something like that.
Yeah. No, it was fantastic.
Real
It was
character.
fantastic.
Yeah, for sure.
Yeah.
Well, thanks for sharing that with us. So you want to
Yeah.
touch on some questions, or you want to
Do
go?
we want to do gold or questions? What do you want to do?
Let me take a couple questions, and then
Okay.
we can move into gold. I'm sure we can cover that. First one here is from Anonymous. He basically says, other than gold, crypto, and dollar-denominated assets like stocks and bonds, treasuries, where can you invest and put cash and have some kind of return? Or rather, what's the best, safest asset that's relatively liquid if the dollar collapses scenario, right? I think you'd argue that the problem is the dollar's going up, not down, but
Yeah, but
you think the
listen,
best thing right now?
you have to, anything's possible. And so I would say, gold is obviously, if the dollar is going to collapse, you want to have gold. I mean, that I can't think of anything better to have than gold if the dollar collapses. Now, other than maybe bullets, right? But
And food and water. Yeah.
but this is the thing, is you just don't know. I mean, I think a lot of times people think, I have this gold, I have this Bitcoin, whatever happens, I'm going to be okay. Well, I think probably so, but you just never know, right? I mean, there's just so many possibilities out there. But I think the most important thing is just to try to prepare for everything and try not to be surprised by anything.
Adrian, anything you want to add to that?
Yeah, I'll just, if I may, if you don't mind, the gentleman asked, where can you put dollars to get some kind of return? One of the sectors I like, and Brent, you and I have never really talked about a sector, maybe you have views, but there's a group of companies in the US called business development companies. These are companies that lend money to small and medium-sized businesses, private businesses, mostly loans, some equity. They're like REITs. They don't pay tax at the corporate level if they distribute it all to shareholders. And so the yields on this tend to be very, very high. The largest business development company is a company called Ares Capital, ARCC. It's also one of the oldest BDCs, but it's the largest. It's about 16 billion. Don't quote me on that because prices go up and down. But they are getting 11% average on the loans that they make, 11% average, and their yield is over 9%. So, and it's fully covered by, at the moment, it's fully covered by net operating income, which is the interest on the loans plus the net capital gains, net operating income, which is what they have to distribute. So I think for people who are particularly older people who are looking for income, that group of companies, business development companies, is an astonishing place to invest. So I like that. There are also, I mean, and Brent knows this, I mean, you and I differ, Brent, in that you tend to, correct me if I'm wrong, you will tend to do more funds and ETFs and less individual companies. I will tend to do a lot more individual companies. And so I can say that the British market right now is relatively cheap with a high dividend yield. It's about 3.6% dividend yield for the largest companies, but you can get yields of 6 and 7% in the British market on good quality companies. Hong Kong, of course, has very high yielding companies, but comes with a risk that we've talked about. But I tend to be bottom up, and bottom up, you look around the world and there are some just really great companies, large and small, but I think are able to withstand, the stuff we've talked about, and it have yields, 5-6%. So I think they're out there.
I'll just add from my world, precious metals dealer. I think if you're looking for insurance, it's always gold. But if you're looking for profit, it is hard to make a case against silver right now. It has been lagging for years. Typically in these bull markets, it will be a late stage runner and it will outpace gold. And again, I'm not a chartist, but I've talked about this before. That 45-year cup and handle that silver's broken out of suggests $90 to $100 gold, or I'm sorry, silver. Don't quote me on $90 to $100 gold, my God. But $90 to $100 silver. So there is potential there for profit, but caution, silver is so volatile. I mean, do not, eat Mexican food and then watch your silver prices. You're going to get sick. Anybody else want to add to that, or next question?
I was going.
All right.
Next.
So Robert was saying, interesting, Russia has been managing their economy well. You had made that comment, question mark, but I tend to agree with you. Is it because their central bank is being buying gold or something else? Or is it some other reason?
I mean, I think it's basically because it's not a very big economy, but they have lots of natural gas and lots of lots of oil, right? It's energy, and the whole world needs that.
Gold runs on dinosaur juice.
Right. And then the part of the other reason that their economy has been doing well is because of the war, which sounds ridiculous, but it's kind of a wartime economy. And they're, the manufacturing to facilitate the war has kept the revenues going in. And, it's kind of a crazy thing that if the war were to end, you obviously want the war to end, but I wonder what that would do to Russia's economy if that happened.
Yeah.
Especially if the war ending caused oil to drop even more.
Gotcha.
Well, and the key, as you said, is they're a resource economy primarily, and they're producing resources that the rest of the world needs. And, moral, immoral, whatever, the fact is that even though they're the pariah and there's sanctions, they can sell their oil. They can sell their platinum. If they were Switzerland producing the best cuckoo clocks and the best chocolate in the world, plus the best watches in the world, sanctions might be biting a little bit more.
Yeah, gotcha. All right. So Renaud has a question here. He says, is it possible for the euro dollar system to change its collateral of choice away from bonds without falling apart completely or entirely? Or has the repo system become so entrenched or permanent that only a change in banking regulation could incentivize banks to lend and provide liquidity to the real economy? So we have time to dissect that.
I would argue it's a combination of the two. Could they switch the collateral? This is the problem, is to get the whole world. It is so ubiquitous. It is so entrenched throughout the entire world. To get everybody to switch over to this new asset or this new collateral at the same time, under the same circumstances, under the same implementation rules, and who's gonna design it, who's gonna implement it, who's gonna enforce it. It's just really, really hard to do it. So I'm not going to sit here and say it's impossible. Nothing's impossible. But if anybody who's ever gone to Thanksgiving dinner with the family knows how hard it is to get 10 people to agree. So to get 10 or 20 billion to agree, it makes it even harder. And then to your point, I think this whole repo and the whole posting of collateral, posting of tier 1 collateral, and then leveraging off of it, it's just another way that the entire system is leveraged, right? And that all works fine as long as the economy is expanding. But the minute it stops expanding, now you've got multiple claims on, individual pieces of collateral, and that's usually a recipe for disaster.
All right. Anything to add?
Nope.
All right. So we've got a few more questions. One of them talks about gold. So I want to use that, and then we're going to segue into your thoughts on gold here going forward. So Rick says, do you think the gold held by the U.S. is likely to get revalued above $42 an ounce? And if so, what would be the consequence?
So I'll say I think it's unlikely. It's obviously not impossible. The U.S. wouldn't hold all that gold if they didn't think it could be to their benefit at some point. Part of the reason I don't think it will, at least not willingly, and I think if it was, I think it would be kind of as a last ditch or kind of a Hail Mary effort. But part of the reason I don't think that they want to do that is that they've spent 50 years trying to get the gold out of the monetary system and stigmatize it such that if you say anything positive about gold, you're kind of this crazy tinfoil hatter, right? And so for them to turn around and then remonetize it, I think would undo 50 years of work to some extent. But clearly, gold is extreme. Every central bank and every government in the world wouldn't try to hold on to it if it didn't have some value. But here's what I think is interesting. I think they hold gold for a couple of reasons. I think they hold gold for insurance reasons. They know that in a crisis, it's the ultimate form of payment. It can be remonetized to put, inject new cash into their banking system or into the government checking account. But the other reason I think they hold gold is for the same reason they hold, political prisoners. If they can hold them, they can control them. And so if the U.S. government has control of the gold, it keeps China and Russia and perhaps some other potential, competitors from doing something with it. So even though they may not want to remonetize it themselves, they don't want somebody else to remonetize it, against them. So I think there's some of that as well.
Yeah, it all comes back to the Wizard of Id in the end, the cartoon strip where he who has the gold makes the rules, right?
Yeah.
So, Adrian, anything to add there?
Well, no, except I think that saying goes way before, what was it called? Wizard of what?
The Wizard of Id is cartoon strip, and that's where it's actually
Never heard of it.
edited.
He who has.
I think it's kind of like your what is it, Axis and Obelisks that you and Lobo.
That's
always talk
Lobo.
about?
That's not me.
Oh, okay.
That's Lobo.
I think it's kind of similar to that.
So,
Yeah.
all right. So
more questions?
Well, there are, but one's real easy. I'll just answer it. Yes, this is being recorded to include the full Q&A, and it will be sent out. If you registered for this webinar, whether you attended or not, it will be sent to you tomorrow with a full email recap. So you're going to get it. Don't worry.
Like
if you don't get it by tomorrow morning, reach out and let us know, and we'll get it to you. Something went amiss. But what are your thoughts on gold in this environment and going?
Yeah, well, so it's funny because I consider myself a huge advocate for gold, but I think of gold, I think much differently than the average person who either operates or spends a lot of time in the gold world, because I think gold is so important. It should be the foundation of just about every portfolio. But how often do you think about the foundation of your house? Very rarely, right? You go into the kitchen and you make something to eat, and you go in your bedroom and you sleep, and you go into the family room and you watch TV. And that's kind of how gold is for me. Like, I own it. We first started buying gold for clients and myself back in 2006, 2007 timeframe. And I remember during the financial crisis, I think it went from like 800 to 600. And I remember we bought some then. So, I mean, we've been buying gold for a really long time. But I just don't think about it all the time, because I trust that it'll be there. It's more of an insurance policy than it is, a moneymaker. I will trade gold tactically, but that has nothing to do with our strategic allocation that we never sell. Yeah. But I will say also, when people say they will never sell no matter the price, then I would say, well, then you don't even need to own it. In other words, like, we have the strategic gold allocation, but if gold trades at $25,000 tomorrow, I'm selling some of it, right? Because that's why we own it. We own it. So if and when this cataclysmic crisis ever happens and gold gets revalued to whatever huge number it is, then I'm cashing that insurance policy in and I'm moving on to whatever is very undervalued at that time, right? But the funny thing is, the first thing when I wake up every morning, I look at my phone, and the first two things I look at, the first thing I look at is gold price, and the second thing I look at is stock futures. But after I look at it, if it hasn't moved like $20 or $30, I don't really think about it too much, because.
So you've been thinking about it the past couple of days then, right?
Well, yeah, well, it's actually a good time to have this conversation. So, what was it? 3 weeks ago, it was at 34.50 or something.
Got to 35.
And it was funny. I'm in a chat group with our friend Peter, and you can imagine how that was blowing up the night that gold was trading at 34.50. And then I happened to see him a couple of days later, and he was very excited, right? But when gold makes a move like that, unless the real crisis is really here and the whole system's getting ready to come down, then thank God we bought it years ago, because you don't want to buy gold in that type of in my opinion, that's not the time to buy gold when everybody else is buying it. Sentiment's off the charts, relative strength's off the charts, positioning, is really long. But now that it's pulled back, I mean, now if you don't own gold and this pulled back 10% from its high, it's probably time to start adding to it. My guess is that we'll probably bounce around, the 3,000 to 3,200 level for the next 2 or 3 weeks, maybe a month into the summer. And then we probably get another run higher in the fall. That's my guess right now. But like I said, I don't really care whether it goes higher or lower, to be honest.
Yeah, we're aligned there. Adrian, you want to add anything?
Well, no, absolutely. I agree with you that gold is should be the foundation, the insurance and so on. But I mean, it's also an investment asset.
Yep.
And I think you've given us some of your views on that, but how do you see it? We know why gold has been going up so much over the last couple of years. And it's interesting that you said both gold and dollar are going up. And it's, counterintuitive because, most people, if you ask them, they would think that gold goes up when the dollar goes down and vice versa. But how do you see, if you were to look ahead? I think you've mentioned, do you do gold stocks as well, or just?
I have in the past, but not for the last 7 or 8 years. I haven't been in gold stocks.
Okay,
I'm
so
not against it. I'm not against it, but it's just we feel like we've been able to me, gold stocks to me are a speculative asset. And we've had more success speculating in regular US equities than we have in gold equities.
Okay.
It doesn't mean that it's not a great place to speculate, just we haven't particularly done it.
No. And so as a tactical investment, not as a long-term insurance, as a tactical investment, would you be buying gold here?
Tactically, I would probably not be buying gold yet, but maybe in the next couple of weeks I would be.
Right.
But from a strategic point of view, if you are looking to add or you don't have any right now, then we've had a 10% pullback. It's time to start adding it to your portfolio.
I think we agree 100%. Yeah.
Yeah.
For my clients that are fully loaded, I'm not adding at this point.
Yeah, but I agree with you. You see this pullback, right? And the first question I ask myself is, has anybody showed any desire or intent to balance a budget? Okay.
Yeah.
If they haven't, then the only way to pay for it was with expansion of the money supply. So gold's going higher. So if you haven't, I agree with you. It's time to seed your insurance policy for sure.
Well, I'll tell you what's pretty interesting to me is that I follow the Commitment of Traders report pretty closely. And, even when gold got to 3,400, the commercials got pretty short, but not like super, super short. And they have actually, with the 10% pullback, they have covered a lot in the last 2 or 3 weeks. And they are not excessively short right now. Right. And I typically use that. If it's excessively short, then, hey, this is not the time to be buying. And if they're really, very only a little bit short or even net long, then you want to be loading up from a tactical perspective.
Sure.
And I'd say right now, it's not super compelling to short it right now. And if anything, it's probably getting into the point where it's probably time to start thinking about buying it. Because again, a 10% pullback, that's a pretty strong pullback, right? Yeah. That's not,
especially in an asset like gold.
No, exactly. But yeah. I do think I think it's also, I think it got way ahead of itself. I don't think it should have gone to 34.50 to begin with. I understand why it did, but to me, that was getting the speed with which it went there. Typically, when something moves that far, that quickly, you're going to get a pullback, and that's what we're getting now. So again, if when gold was at 34.50, if you were saying, "Gosh, I really should have bought it when it hit 3,000," well, then we're maybe it's time to start looking at it because you might get a chance to do that again.
Well, I'll just add this empirical data, as a dealer and what we experience working with other dealers and speaking with wholesalers. I will tell you the Western investor, and I've been saying this for years now, right, Adrian, still is not in this market. They are not buying. Central banks are buying. That's why your price is high. It's all central bank, a little bit of Asian retail,
buying from China.
a hair of institutional,
here's
but
the
it's not
interesting
retail.
thing. So here, this will help explain my whole dollars and gold rising together. So obviously, when you say that all by itself without any context, that's not possible, right? Because they're inverse of each other.
Yeah.
But the very first time I ever spoke about this thesis, I made it clear that I recognized this contradiction. And I made it clear that when I talked about dollar and gold rising together, I meant versus all other fiat currencies, because all fiat currencies lose value over time. But I believe the US dollar will lose less than the other fiat currencies. And as a result, the dollar and gold will rise versus those other fiat currencies. And over the last couple of years, as gold has made this big move, until this year, there wasn't gold flowing to the United States. It was all flowing to China and to other countries. And until, really just in the last couple of months, gold or dollar had been very strong versus foreign currencies. And that was dollars and gold rising together versus foreign. And my point is, and I said this in my very first interview on this topic, was that I thought gold would go higher, not because everybody's afraid of the US dollar. It's because they know they need to protect against their own fiat currencies. In other words, when people in China buy gold, they don't wake up and say, oh my God, Trump and Jay Powell are totally out of control. The dollar's going to lose value. I need to go buy some gold. No, they say, holy shit. Sorry, Adrian. Didn't mean to offend you there.
You promised.
Holy cow. The yuan is a horrible currency. I need to get out of this before they devalue it. So I'm going to go buy gold. Right. And it's the same thing in Turkey, and the same thing in Egypt, and the same thing in South Africa, and the same thing in, France. They're not doing it, in my opinion, they're not doing it because of the dollar. They're doing it because their own fiat currencies are horrible as well. Yep. And I think that kind of lends credence to the whole idea of dollars and gold riding together.
Right, right. And to Rich's point about, he's getting more people wanting to sell coins than he is wanting to buy coins.
Yep.
You look at the ETFs, and you're still seeing inflows into the physical, but you're also seeing outflows from the physical. It has not been a wave of buying into gold in North America. And if you look at the gold stocks, look at the GDX. The GDX has lost $3.4 billion in net outflows this year. I mean, it's astonishing.
That's kind of the reason. That's kind of the reason I look at gold stocks or even GDX, the ETFs and stuff. I'll trade those tactically, but I don't see them as a long-term hold. If you go back, if you look at GDX since inception, GDXJ since inception, what's the other one? Is there a Philadelphia Gold Index? I think if you go look at those, I think they are all negative since inception. And that doesn't even include the companies that have been taken out of those indexes. Now, it doesn't mean, I want to be clear, I'm not telling people they shouldn't buy gold stocks. And I think they have a place in a portfolio. And I think if gold price goes much higher, then I think these companies will do very well. But I see them see them much differently than I do gold itself.
Brent, I think you need a specialist expert to help guide you with your gold.
Adrian, I was just going to say, if you only knew somebody in Puerto Rico who
didn't
was
let me finish. I was getting ready to say, if you need any help with the individual names, Adrian Day is the guy to do it for you.
Well, we're all on the same page here.
I got to tell you, so Adrian's been managing funds for us for what, 20 some odd years or more. We're not idiots. All right. If he wasn't delivering value, we wouldn't be with him. I highly recommend Adrian. There's no question in that area. Much better than trying to go it alone. I promise you, by a long shot.
Not only that, but I will say this. I hate doing this, but I'm going to do it. Like he is a true gentleman. Like in the truest sense of the word, I always tell my wife when we go out to dinner like once a month, and I would say, oh, I'm looking forward to going out with Adrian, because I always feel like I'm going to kind of like this little special occasion, where I get to sit with this English gentleman and pick his brain a little bit.
Yeah. Oh, well, that's kind, but thank you. And listen, we still have not met your wife. Does she really exist?
You want me to go get her?
Well, I've met your son. Very nice.
Well, yeah, to be fair, I haven't met your girlfriend either.
Well, that's right. Okay.
Sounds like we have a double date brewing. So we have two more questions. My question is, we're about the end here. Do we have time to cover them quickly?
Yeah, go on quickly.
And then I do want to make the rounds and just have everybody, let the audience know how they can get a hold of us. We've got a special I want to mention as well. And then your last parting thought. So let's say it's Derry, says, can the United States realistically weaken the dollar with how much demand there is for the currency? The DXY is already back above 100, for example. So what would it take to succeed?
So in my opinion, they can absolutely weaken it for a short period of time. But we will unless they completely reset the system, we will inevitably end up back here with the dollar strong again. Because the method via which you introduce liquidity, which causes the dollar to fall, is loaning new money into existence. And then in the medium to long term, that money that's been loaned into existence creates a demand to service and pay off that debt. So in the short term,
dilemma.
Anything, that's the dilemma. So anything can happen in the short term, but very astute observation. I think I think that's ultimately what happens is it gets away from them and it goes higher than they want it to.
Good point. All right. And then Eric asks, and this is the final question, is China set to remain the commodity powerhouse of the future? We see this recent willingness by Western governments to develop critical and strategic metals a little too late, as social acceptability, environmental constraints still heavily remain. So is China going to be our commodity powerhouse going into the future?
As far as manufacturing or the mining of it?
I'm thinking both. Aren't they the leader in both those areas?
No.
I have a little bit of a alternative opinion on this one.
Okay.
So I don't think it's going to be easy, and I don't think it's going to happen right away. But ultimately, I think the combination of United States, Mexico, and Canada will be the resource capital of the world.
Yeah. On many, I mean, and just on many commodities, China's not the powerhouse in terms of production by any means,
but
it is the major importer.
There you go.
Right.
That's what I meant.
Yeah. Okay.
Yeah. All right. So that's a first in a while. We've actually got through all the questions, but I want to run a hair over here. And let's, I guess, start with you, Brent. One more time, let people know how they can find you. And then if you want to leave them with just one thought, what is that going to be right now?
Sure. So the best way to find me is if you go to just santiagocapital.com. It's basically a landing page with my contact information, and you can contact me there. Again, if you're interested in reading about some of the stuff that I've talked about tonight, the best way is to go to santiagocapital.substack.com. You can go to Milkshakes, Markets, and Madness on YouTube, and then you can follow me under Santiago Capital on Twitter.
Fantastic.
And the thing I would leave everybody with is try as hard as you can to be open-minded, no matter how much you are tied to an idea. And I know everybody will say, well, Brent, you're tied to the dollar. But the reality is I spend most of my day trying to figure out how I could be wrong. So, but the point is, don't be so dogmatic about a certain topic. Don't be so dogmatic about a certain way of thinking, whether you're an MMTer or whether you're a gold bug or whether you're a Keynesian or whether you're an Austrian. And try as hard as you can to kind of pick the pieces of wisdom from all of them and don't get pigeonholed into one point of view.
Fantastic. And that link to your Substack will be in the recap email tomorrow. Adrian?
Yeah, to find me, go to, what is it? adrianday.com. That's right. Sorry. adrianday.com. And then you can find out about the newsletter and the money management and different interviews we've done are on the website. Yeah, and the parting thought, I was going to say much the same as you. I think one of the things you've really taught us is that you've got to separate what you want to happen from, what you actually think is going to happen. And particularly in the short term, you can be right with a long-term thesis, but if you follow gold and gold stocks, you know that, short term there's volatility. And, I don't believe in timing markets, but there's definitely a time to buy and a time to sell. I think we're going to head into a great opportunity for buying gold stocks over the coming weeks, maybe a couple of months. I don't think this is it, but we're going to come into a great buying opportunity for people who are underinvested.
Gotcha. And Adrian, if you could, you want to tell them about Adam and our next guest as well while you've got the spotlight.
Our next guest, will you give the date? Because I've forgotten it. Is it
July 16th, Wednesday,
July
7
16th.
p.m. Eastern.
Yeah, and next guest is Adam Rozencwajg from the firm of Goering and Rosenzweig. I don't know if you know them, if you're familiar with them, Brent. They do great research on all of the commodities, on all individual commodities. That's their specialty. And that's going, yeah, he knows more about the commodities than anyone I know. So it's going to be a really interesting discussion.
Fantastic. And then for my last parting shot, so if anybody wants to take Brent up on his recommendation with the 10% pullback and pick up some gold, we're going to make that easier for you here. So anybody that listens tonight, gets the recap tomorrow, wants to go ahead and buy some gold, every 3 ounces of gold, I don't care what form it's in, bar, coins, whoever makes it. If you buy 3 ounces of gold from us, every 3 ounces, we're going to give you a free silver eagle. So we're going to build up your gold and your silver reserves at the same time. And my parting thought is something that you sent earlier, Brent, and I loved it because I'm beginning more and more to believe it. I wrote about this in last week's Information Line newsletter. We got to stop thinking like if you don't agree with me 100%, you are the opposite end of the spectrum and you're pure evil.
Yeah, yeah.
Amen.
Thing that we're talking about in terms of economies, markets, political beliefs, etc. Typically, you've got somebody that's got this view, and you've got somebody on the polar opposite, and the answer probably 100 or just 99.9% of the time is somewhere in the middle. Okay. And I agree with you. Be open-minded. Take it all in. Don't let others tell you what to think. Process it yourself. Be a critical thinker and make up your own mind. And I think you'll find yourself a little closer to the middle than on the spectrum and the outskirts. Adrian, as always, thank you. Brent, fantastic to meet you here tonight. Look forward to seeing you in the future and maybe have you on again in the future. And for everybody that joined us, thank you for attending. I hope this was helpful, and we look forward to seeing you on July 16th with Adam. Have a great night.
Thank you. Thank you, Brent. Is that it?